Vietnam just issued a sweeping decree overhauling its commodity market, promising clearer rules, faster clearing, and a new path for listing futures and spot products. In a year when domestic inflation pressed into double digits, traders, farmers, and processors suddenly have a stake in a more transparent price system. The move echoes global shifts towards central counterparty clearing and standardized trading, seen in London, Chicago, and Shanghai, but adapted to Vietnam's growing manufacturing base. If implemented well, it could reshape hedging, risk control, and capital flows across this fast-evolving sector, with ripple effects beyond Vietnam's borders. Investors are watching the details for clues on margins and eligibility. The decree formalizes what market participants already sense on the ground, a transition from loosely coordinated trading to a regulated, centralized framework. Clearing will become mandatory for specified commodities, meaning a central counterparty will guarantee trades, reducing counterparty risk for buyers and sellers. Listing rules will specify who can launch contracts, minimum capital, and ongoing reporting, similar to how stock exchanges screen listings. Think of it as upgrading from a local market hall to a modern exchange with standardized contracts, price discovery, and audited records. Operators will also be required to settle trades promptly, publish daily settlement prices, and maintain clear margin requirements. Vietnam's commodity markets have grown rapidly alongside manufacturing and export ambitions. Before this decree, trading often occurred on informal platforms with opaque price signals and variable settlement practices. The state has long guided agricultural pricing through agencies but has struggled to provide robust risk management for industrial buyers and exporters. In the 2010s, foreign investments surged into grains and metals trading, while the domestic market remained fragmented across provinces. The new rules reflect a broader push toward market liberalization and financial infrastructure, inspired by peers in Singapore and Malaysia, yet tailored to Vietnam's small and medium-sized enterprises and bank balance sheets. Initial reactions tracked across trading desks and farm groups show cautious optimism. Traders expect tighter risk controls to curb sudden price swings, much as CCPs did after the 2008 crisis in major markets. Banks signal higher demand for financing tied to transparent margining, while brokers prepare to implement daily settlement cycles and more rigorous know-your-customer checks. In the immediate week after the announcement, some contracts saw price discovery improve with tighter bid-ask spreads, while others remained conspicuously illiquid as participants awaited official clarifications. Overall sentiment is a bridge between nostalgia for informal markets and readiness for modern regulation. Farmers selling raw staples, small processors, and export houses stand to gain certainty or lose flexibility, depending on contract terms. Multinationals with regional hedging arms will adapt to standardized futures, while domestic banks may reprice lending under stricter collateral rules. Exchange operators and clearing members must recruit liquidity providers, risk managers, and compliance staff, potentially forming new partnerships with global CCPs. Private equity and venture capital investors eye rails for logistics, storage, and trading, while retail traders fear stricter This shift as much as local regulators. supply chain resilience amid rising global commodity prices, with crude hovering around 80 to 100 per barrel and copper near $9,000 a ton in recent months. A stronger yuan, US rate volatility, and export demand from Southeast Asia influence cross-border flows. Domestic inflation remains a concern, pushing policymakers to deepen hedging options to keep consumer prices stable. The decree also aligns with regional ambitions for digital markets and financial inclusion, inviting foreign investors while insisting on local capacity building and transparent enforcement. Smart money is passing the decree for hedging efficiency and market access. Sovereign wealth funds and large asset managers, like in Singapore and Korea, are briefing desks to model new contract sets and margin schedules, comparing to CME-style risk controls. Local banks are considering tiered collateral requirements, while fintechs test API links to exchanges for faster settlement. Retail investor platforms are updating educational content, explaining how to manage margin calls and position sizing in a rising liquidity environment. Across the board, capital is flowing toward infrastructure, plays such as storage terminals and logistics hubs that benefit from clearer price signals and regulated trading. Risks remain that the decree outpaces actual market readiness. If penalties, delisting criteria, or settlement delays prove inconsistent, liquidity could dry up and price discovery regress to rumor and gray markets. Concentration among a few clearing members could create systemic risk if capital bases are thin. Small traders may face higher margins, squeezing participation and eroding social goals of reform. Foreign participation constraints might limit cross-border hedging and slow technology transfer. Behavioral shifts, such as crowding into a few futures, could amplify volatility during transition, echoing early phases of reforms seen in other developing markets during the 2000s. Regulators must act quickly to calibrate risk controls. For retail investors, the core message is, do not chase hype, but plan for informed participation. Start with education, how margins work, how settlement cycles may move faster, and how to spot fake liquidity. Diversify exposure across commodities and contract months, and consider small position sizes to weather gaps in liquidity. Use stop-loss and risk budgeting to avoid one bad morning wiping out gains. Monitor official guidance on listing eligibility, margin rates, and the timetable for rollout. If you already own related stocks or ETFs, evaluate how clearer price signals could affect fundamentals and adjust holdings with a clear long-term risk framework. Looking ahead, the decree could unlock a phase of deeper capital formation in Vietnam's commodity economy, provided implementation is steady. Markets may see improved hedging, clearer price signals, and better risk disclosure as exchanges adopt standardized contracts, margins, and settlement timelines. The transition will test liquidity across grains, metals, and energy, with regulators promising iterative updates based on real-world feedback. For producers and investors, the path is reform balanced by caution, as infrastructure and compliance costs shape early adoption and scale. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.